Most stocks perform worse than bonds, yet the stock market overall performs better. And it can all be explained by one of the most powerful concepts in investing, the power law. According to a widely cited 2018 paper, only 4.3% of all stocks, or the top 1,092 companies, were responsible for the entirety of net wealth generated by the US stock market since 1926. Said differently, if you remove that top 4.3% of stock returns over the past 100 years, the stock market gains would have been equal to treasury bills, the essentially risk-free asset. The same holds true in other markets, with the 2021 paper finding that in the vast majority of countries, less than half of stocks have outperformed treasury bills since 1996. This graph shows some of the underlying data from the 2018 paper. Most stocks actually had a negative return, another significant portion generated returns less than treasury bills, and yet another group produced returns less than the market overall, or in financial speak, they were not accretive to market returns. What's left are the roughly 1 in 20 companies that ultimately helped the S&P return us roughly 10% CAGR over the past 100 years. That's the type of return that turns $100 into more than 1.3 million. The pattern of just a few companies generating the vast majority of returns is known as the power law. If you've heard terms like the 80-20 rule, the Pareto principle, etc., they are all basically describing the same thing, and I've always found it somewhat surprising how few people are aware of the type of impact it has on overall returns. And these distributions show up in places far beyond just the returns of common stocks. It shows up even more powerfully in venture capital, and things like the number of profitable traders on Kalshi, and even in income distributions within countries. But back to stocks, the question we want to answer is why do power law outcomes happen so much? And the reasons, in my opinion, are fairly straightforward. Running and growing a company is an extremely hard thing to do. Even once you've IPO'd and have a certain level of size and presumably some product market fit if you manage to become public, it's always hard to keep that going. Markets change, technologies change, there are bigger competitors, you name it. Basically, there are a lot more small cap struggling companies like Dunder Mifflin out there than there are Nvidias. You know about Nvidia because it is the exception, not because it is the rule. The other reason the power law tends to happen is that while losses are capped at 100%, there is no limit to how big a company can grow. And when a company finds a big enough market, it gets very, very, very big, with the top cumulative returner generating a return of more than 2.6 million%, a number that our brains can't even really imagine. And yes, that stock is Altria, the tobacco company. Now, I think the core point here is actually a lot bigger than it initially sounds like. Most people invest in stocks because they are looking for a higher return than other assets, generally bonds. And because there's a level of risk in stocks, nobody would invest in them unless they think they can produce a higher long-term return than historically risk-free US or similar country bonds. And if nobody was willing to invest in companies, we'd all likely live in a much poorer world. Why invest in risky innovation or in developing new products or services if at best the reward is the same as lending to the government? It is only because of those outlier returns from a select few that the entirety of our modern capital markets work. When investing $500 a month for 30 years, the difference between earning the 3.5% rate of the market without outlier companies or the 10% with outlier companies is not some immaterial difference between hamburger or steak. It's more than $677,000 and whether or not you are able to retire. The good news is that for most investors, you actually don't have to worry too much about the power law because you're probably already set up to capture it. Index funds will by design capture all the power law outcomes along with the long tail of meh returning companies. But in aggregate, it will still produce very strong overall returns. The power law also suggests that successful stock picking is at least theoretically possible. If you can pick companies to avoid the long tail of meh returners, you could produce far above market returns. Of course, the fewer bets you make, the higher the chances you might miss those positive outliers as well, which is why for most investors, index funds are still probably the way to go. If most companies that graced your Vanguard fund never existed, you'd never notice. But the reason that index investing works, and the reason that investing works at all, is because of the power law. It is not a bug of finance, it is the core feature.